Hello and welcome to the Weekly Outlook at XM.com. Next week will be an important one with all eyes on central bank decisions from the Fed and the ECB, as well as the latest non-farm payrolls data. I'm Maria Pachordes, and joining me is Senior Investment Analyst Marios Hadjikyriacos. So Marios, let's start over in the U.S., where the Fed will deliver its rate decision on Wednesday ahead of the employment report on Friday. Although there are signs that the U.S. economy is improving, do you think a recession is still on the horizon? What are we expecting to hear from the Fed, and how might the dollar react?
Hello, Maria. So we've gotten some pretty encouraging signs out of the US lately. Specifically, the last round of business surveys painted a very optimistic picture. It pointed to an economy that is regaining momentum. It mentioned a resurgence in demand, an acceleration in jobs growth as we enter the second quarter. So all of that helped to dispel some recession concerns, at least for now. Now, the problem is the bond market continues to scream that there's economic pain on the horizon, and even the Fed's own staff in its latest projections expected a mild recession to begin later this year. So the general sense in the market is that the recession has been postponed but not cancelled. And this is why I think that the market continues to price in Fed rate cuts towards the end of the year. So let's take a step back. The Fed meets next week. The markets expect a rate increase, which is priced in with a 90% probability, but they also think this is going to be the final rate increase of this cycle, the finale. After next week, the markets think the Fed is going to take the sidelines for a few months before they start to cut interest rates towards the end of the year. Now, the question for next week is the following. What does the Fed signal moving forward? Do they say something like, our job is done, we've done the rate increase we want, or do they keep the door open for more tightening? Now, from a risk management perspective, it makes more sense to keep the door open for more rate increases. The economy is not rolling over just yet, and in fact, inflation seems to be stickier than many people thought. So that suggests that even higher rates might be required. So what I would expect to hear from Chairman Powell next week is something like, this is a very uncertain period, therefore we are going to be data dependent and we can still raise interest rates if needed. Now, considering that the market is not expecting any further rate increases, that message could catch investors by surprise, I think, and it would be beneficial for the dollar, especially if Chairman Powell pushes back against speculation for rate cuts like he did at the previous meeting. So I see some scope for a stronger dollar after the Fed, but on the data front, on Friday, we are going to get the employment report. The forecast is for another decent jobs report, non-farm payrolls at 180,000, but the signals that we've gotten from early indicators, Maria, so far have been a little bit mixed. So the business surveys painted a very optimistic picture, fastest pace of job creation since last summer. But on the other hand, applications for unemployment benefits rose during the month, which suggests that we're starting to see some worker layoffs. Now, we've gotten some mixed signals so far, but we have several data releases in the lead up to Friday's jobs report, and those are going to provide more color for investors.
Now, moving over to Europe, we'll get the latest inflation numbers for the Eurozone on Tuesday and a rate decision from the ECB on Thursday. What size rate hike are we expecting there, and what's the outlook for the euro?
Yeah, so investors are a little bit split on what the ECB is going to do next week. A rate increase is certain, quote unquote, but there's uncertainty about the size. So specifically, the markets are assigning a 70% probability for a smaller rate increase of 0.25% and a 30% chance for a larger 0.5 percentage point rate increase. Now, it's a tough choice for the ECB because on the one hand, yes, the Eurozone economy also seems to be gathering momentum and inflation continues to rage, but the ECB is also cautious of overdoing it. They don't want to inflict unnecessary damage on the economy by raising interest rates too much, especially since the full impact of all their previous rate increases has not been felt yet. So with all that in mind, a middle-of-the-road solution, which is what the ECB usually does, is to do the smaller rate increase, but accompany that with hawkish language and hint at more rate increases to come. That, of course, is more or less what the markets are pricing in right now. The market thinks that the ECB is going to continue tightening through the summer. Now, in case we get a smaller rate increase, I think that would be a little bit bearish for the euro, given how markets are positioned right now. But in the bigger picture, what we are seeing is the euro seems to be riding this wave of central bank divergence, this expectation that the Fed is going to pause next week, but the ECB is going to continue raising interest rates. And that is a very positive force for euro-dollar. However, for euro-dollar to continue its upward trend, we would need to see a break above the 1.11 region, which is a very crucial territory.
Marios, thanks so much. And thanks for joining us for this weekly Outlook at XM.com.